Hey everybody, and welcome to another Business and Life Tip. I'm Tim Brahim. This Business and Life Tip is brought to you by Performance Experts Coaching and the 360 Experience podcast. Today's subject matter is the 2-1 buy down loan, or any type of a buy down loan. Now, I know you all know about it at this point. This is a product that I used to sell back in the 2000s, 20 years ago, a lot. I know how to market it, I know the scripting around it, and I know how to sell it against other types of products. So I want to share some strategies with you right now. Now, first of all, what differs in this product now versus 20 years ago when I was selling it is that the borrower actually gets the money back from most lenders if they're not in the loan for the full 2 years of that buy down. That's a very important footnote that I want to get back to in a minute. So some of you right now, my clients are sharing with me that, hey, I'm competing against credit unions that have an interest rate of 5.5% on a 5/1 ARM. And that's a tough thing to compete against with the 2-1 buy down. I mean, if I'm at 5, 6, and 7 on that buy down that's subsidized by the seller, why would they take that over that 5/1 ARM? Well, okay, here's one of the ways to position the buy down. I would say to borrowers all the time, I want you to think of this loan as an adjustable rate mortgage, even though it isn't. I just want you to think of it as an adjustable rate mortgage with a very, very low life cap. What we know for sure is it's fixed for 1 year at 5, the next year at 6, and then years 3 through 30, the remaining 28 years at 7. What we know for sure is the guaranteed average in those first 2 years, those first 24 months, is going to be 5.5%. Now, that 5/1 ARM that you're thinking about taking, that's at 5.5%, is going to be fixed for 5 years. But then what happens after the 5 years? Now, the problem with a lot of banks and credit unions is that they want to hold those loans on their books for as long as possible. The originators that work for those banks and credit unions do not have a financial incentive of any kind to manage the indebtedness for their clients on a go-forward basis. My worry is if you take that loan and the period of time goes by that it's fixed and it rolls into an adjustable, you now on that loan have an 11.5% life cap. So it's a much more inferior product. I feel very confident that in today's marketplace that we're not going to see interest rates stay this high. Rates are going to come down because of the cyclical nature of interest rates, and they should come down sometime in the next 12 to 24 months based upon all the experts that I know in the business and what they're sharing with me. So what's more important than anything is that you're aligned with a debt strategist, a financial advisor who specializes in debt management, which is what I do. And my strong recommendation is that we take the seller's subsidized buy down at 5 for the first year, 6 for the second year, and that I watch for other opportunities for you on an ongoing basis going forward. Now, if I get you out of this loan in less than 24 months, you're actually going to get some money given back to you that you can use for your future refinance, which you wouldn't get in that 5/1 ARM product. But more importantly, be thinking about whether or not you feel comfortable with the intentions of that credit union or bank loan originator that you're talking to, because I guarantee you they don't have the same incentives to move you into cheaper money what's available that I do. I hope that you find this scripting and this strategy on the buy down product right now to be helpful. Please make sure that you check out the 360 Experience podcast, subscribe to it. Got a lot of great content coming your way, really valuable information that I think is going to help you. Thanks a lot.